Welcome to today's video. First, we're going to challenge a comfortable belief that staying put is safer for your career. Instead, we'll discuss why geographic mobility is often your greatest asset. Next, we'll show how early, higher earnings compound and can change your lifetime wealth trajectory. Then, we'll cover negotiation tactics to protect your savings and accelerate your start. Finally, we'll share a practical 12-month plan to adapt in a new city and build your network. Let's dive in. Here's our roadmap. First, why mobility beats comfort for growth. Second, the money math behind moving, including compounding. Third, the negotiation playbook to secure relocation support. Fourth, a 12-month plan to build momentum. Fifth, risk management and how to mitigate downsides. Sixth, 2 quick quizzes to test understanding. Lastly, key takeaways and next steps. Before we proceed, an important disclaimer. This video is educational and not financial, legal, or immigration advice. Individual constraints can include visas, caregiving responsibilities, health considerations, and partner careers. You should adjust any recommendations to reflect your circumstances, tax situation, and risk tolerance. Consider consulting qualified professionals for personalized guidance. With that foundation set, let's continue. Here's the core thesis. If your current location limits your income or growth, staying put can be a costly financial mistake. When you move to where the opportunities are, you unlock higher salaries and steeper learning curves. Both effects compound. Your savings grow faster, and your skills earn you more in the future. Meanwhile, risks like isolation and moving costs are temporary and manageable. We will outline how to mitigate those risks with a 1-year commitment, proactive networking, and a budget buffer. In short, mobility expands your option set, which is a fundamental form of career leverage. Let's talk money. The cold rule is simple. Chase the paycheck early because those dollars compound the longest. You should prioritize roles that either pay more immediately or dramatically increase your learning rate. Next, always negotiate for relocation stipends and signing bonuses to protect your savings from moving costs. That protection enables a rapid, confident start. Finally, remember that isolation is temporary, while career stagnation can become permanent. If you give yourself a defined runway to integrate, the upside generally dominates the short-term discomfort. Here's an illustrative 5-year comparison. The stay scenario starts at $60,000 with 3% annual growth. The move scenario starts at $80,000 with 6% annual growth. In year 1, the difference is $20,000. By year 2, it's $23,000. Year 3, approximately $26,234. Year 4, roughly $29,718. Year 5, approximately $33,468. The cumulative difference over 5 years is about $132,400 before tax. Furthermore, if you invest a portion of that gap, compounding can amplify the advantage significantly over the next decade. Now let's translate this into an action plan. Here's an 8-step relocation strategy. First, research 3 to 5 cities that have dense markets for your role. Second, build a personal ROI model that accounts for salary, cost of living, taxes, and your target savings rate. Third, create a pipeline of 10 to 20 applications for roles that increase pay or learning speed. Fourth, negotiate relocation support. This includes a stipend, signing bonus, temporary housing, and, if possible, a tax gross-up. Fifth, plan your moving budget to minimize out-of-pocket expenses and preserve your emergency fund. Sixth, commit in advance to a 12-month integration window, giving yourself time to adapt and build momentum. Seventh, network deliberately, with weekly outreach and monthly events to accelerate your local connections. Finally, at month 12, review your compensation, skills gained, and network depth to decide on next steps. Negotiation should begin early. Ask for relocation support that combines a cash stipend, a signing bonus, and temporary housing. Next, request a tax gross-up on relocation benefits so taxes do not erode your support. Secure a start date buffer to handle logistics like utilities, banking, and healthcare. If possible, include a house hunting trip or travel reimbursement. Tie compensation reviews to performance milestones in 6 to 12 months. When moving to a higher cost of living area, negotiate both a base salary adjustment and additional variable upside to maintain a strong savings rate. Let's weigh the trade-offs. Staying put offers lower near-term friction, an existing social network, and predictable costs. However, it may also come with capped opportunities, slower skill development, and lower upside. Moving introduces higher immediate effort, the need to build a new network, and logistical complexity. In return, it can provide higher pay, steeper learning curves, larger markets, and faster compounding in both earnings and skills. The decision hinges on whether your current location materially limits your growth. If it does, moving often wins over a multi-year horizon. This flowchart structures the decision. Start by asking whether your current location limits your income or growth. If not, concentrate on local optimization via networking, internal mobility, and side projects. If yes, check whether you have a financial runway of at least 3 months. Without a buffer, focus on building savings while interviewing remotely. With a buffer, apply to 10 to 20 roles across target hubs. If no offers arrive, broaden your city list and strengthen your skill signals. Once you receive an offer, negotiate relocation support, including a stipend, signing bonus, temporary housing, and a tax gross-up. Relocate with a 12-month commitment. Track monthly metrics such as savings rate, skill growth, and network, and then conduct a 12-month review to decide whether to stay, renegotiate, or move again. This timeline lays out a 12-month integration plan. It begins at offer signing, followed by budgeting and logistics. Next, you move in and complete week 1 onboarding. At 30 days, you execute a focused skill plan. At 60 days, aim for a tangible project win. At 90 days, run a performance check with your manager. Between months 4 and 6, deepen your network through mentors and events. At month 6, target a compensation review tied to documented impact. Around month 9, pursue a stretch project to expand your scope. Finally, at month 12, measure results and either renegotiate or pivot based on your progress. Quiz time. The question is, how long should you commit to a new city before judging the move's success? The options are 3 months, 6 months, 1 year, or 2 years. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 1 year. A 12-month commitment gives you enough time to integrate into the team, build local networks, deliver results, and reach scheduled review cycles that can impact compensation. Second quiz. The question is, which negotiation item best protects your savings during a move? The options are higher title only, relocation stipend or signing bonus, extended start date only, or parking benefits. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is the relocation stipend or signing bonus. Cash support directly offsets moving costs and protects your emergency fund, which enables a faster, more secure start in the new role and location. Here is a markdown-style checklist you can adapt. First, collect your inputs. Target salary with equity and bonus, cost of living differences, taxes, and core expenses such as housing, transit, and healthcare. Include relocation support and any tax gross-up. Next, estimate your annual surplus by subtracting living costs, your desired savings, and an amortized portion of moving costs from your total compensation. Prioritize offers that produce the highest surplus and the fastest learning rate. Finally, adopt weekly habits. 3 new professional outreaches, 1 coffee chat or mentor touchpoint, 1 public contribution to build signal, and consistent tracking of savings rate and skill improvements. Here are the key takeaways. Geographic mobility is a powerful form of career leverage. Early higher pay compounds into greater future wealth. Negotiate relocation support to protect your savings. Commit to at least 12 months to integrate and measure your impact. Isolation tends to fade with deliberate effort, but stagnation can persist, so move with a clear plan. To wrap up, if your current city caps your growth, consider relocating to unlock both higher pay and faster learning. Run your numbers carefully and secure relocation support to protect your savings. Then follow the 12-month plan to build your network, compound your skills, and increase your leverage. Now let's close with a thank you and a call to action. Thanks for watching. If this helped clarify your next move, please like the video, Share it with someone who needs this perspective, and subscribe for more strategies on maximizing career ROI. Tell us in the comments which city you are considering and why. Your story might help another viewer make a better decision.